All right, so let's get on with it here. We have a daily chart here on NASDAQ. I want to take your attention to this area right in here. July 17th, 2024. That's a SIBI, sell side imbalance, buy side inefficiency. Now you want to grade that. So what you would do is take your fib, put it on this candle's low to this candle's high. And this is your midpoint, consequent encroachment. This is the high, this is the low. And you want to add the quadrants here. So this will give you the upper and lower quadrant inside of a range that you're grading, or a price swing. So you can do a implied dealing range where you're anticipating the market to deliver in the direction of your target, and you can run a grading using a fib and predict where the algorithm will start to accumulate or distribute new position entries on a longer term price run, or unrealized price target being met while price is going higher or going lower when you're bearish or bullish. I have lessons for that, by the way. It's in the core content lessons on the YouTube channel for free. But the upper quadrant level, consequent encroachment, and lower quadrant level. So you can see we failed on this run here on September 26th. It failed to even get to consequent encroachment there. And then yesterday, we were working the lower quadrant. So just be mindful that that 20,489 level, that level was more or less the level I had in mind, because I saw that it failed on this one here. I'm not abandoning the long-term bullishness on this market because it's an election year. This 538 is the intermediate term draw. That means what's based on a daily chart. That's where the market's likely to pull to next. But I don't need it to go there, which is what I showed yesterday in the executions. So I'm going to give you a little bit more detail, but just know that we're working the lower half of this shaded area here. And because of that, I'm sticking to the likelihood of it wanting to reach further. So being long or going long has been predominantly the larger size of my leverage. So if I'm going to go short, I wasn't all that interested in being short anytime this week, but the fact that we have unrealized portions of this inefficiency traded to. So all of this halfway point, or just below halfway, because it only went to that candle's high there at 538, and you still have 568, which is half of the range between this candle's high and that candle's low. So knowing those things and trying to avoid being quote-unquote right, because I'm not teaching you to be right, I'm teaching you to focus on low-hanging fruit objectives, sticking with a bias, sticking with a directional draw on liquidity that's based on a higher time frame chart, i.e. the weekly or daily, and then sticking to that and waiting for time and price to agree. So just know that this level here, 538, is, in my mind, the draw. But I have to have something that's less than that for a low-hanging fruit objective to reach for and be content with it. Meaning that my trade idea would be satisfied taking something close to this level, but not requiring it to be at that level, but still have sound principles around it to justify why taking that exit is warranted and not just holding on for this objective here. Okay, so with that context, I'm going to drop down into this little area here. I'm going to remove these lines just because I don't want it to be confusing. Now, if you look at what we have on the highest candle here, on September 26th, the high comes in at 20,538. Full disclosure, I've told my students in private mentorship, this is where my draw is for the week. I want to see it trade there. Does it need to trade there? No. What would I take as a consolation? Like, what would be a low-hanging fruit objective? That's what I'm about to flesh out now for you. So half of this range between this candle's close to that candle's high is this level here. So this premium wick is a array where we split it in half because a wick is a gap. So half of that gap is 20,442 and a half. So Thursday, this is the candlestick for Thursday's trading. Now inside of this, what would look like on a daily chart, by all intents and purposes, you can see that there's nothing really inherently exciting about that candlestick. But you also watch me buy near the low and sell near the high, based on the things I'm going to show you here. So we also have this level right there, which is the upper quadrant of this premium wick. And I'll show you what I mean by that. I'm going to add all the levels again. So you can see the halfway point. In this case, it's consequent encroachment, 0.75, 0.25, and the high and low base figures for anchoring your fib. So that's the closing price on the 26th of September to the high of that candle. The upper quadrant is 20,490 even. Consequent encroachment is 442 even. Lower quadrant's 20,393.75. And then you have the low of this wick, which is this candlestick's close. Okay, so the upper quadrant level, right there, when I take the fib away, or not the fib, when I take the quadrants away, you'll see that that's the reason why that's anchored as it is. See? So this blue line here that's dashed, that's what I'm aiming for. And I don't require it to trade up to the high of that wick. So just know that this is the range I was dealing in. It's this candlestick's wick that I'm aiming for the targets on. So what am I going to use as a discount to enter on? Well, now we take our attention over to October 8th. Now notice that we're doing all this work on the daily chart. We're not inside 1 second charts, 5 second charts, 5 minute charts, 60-minute charts. We haven't even left the daily chart yet. So I'm framing the context, how the algorithm is going to refer back to these price points from the daily perspective. Okay, so sticking with the higher time frame, order flow being bullish still, it's an election year. I want to still focus on heavy leverage on longs. And I don't need to be right. So we're framing high probability with low risk entries. This candlestick has a wick as well. See that? Now I'm going to add again 2 boundaries. And since it's a short and stubby type of wick compared to, and by contrast, this one, it's only important to know what the midpoint is, okay, or consequent encroachment. So this wick right here, from high to the close of that candlestick, I want to know what the halfway point is. So that's consequent encroachment. So because price opened up here on Thursday and traded down, okay, well, as soon as it opened up here, this makes this a discount array. That means it's going to reprice down to it, but not only is it just going to trade to it, but my expectation is the algorithm will use this to facilitate some measure of support, accumulation, and then start to rally from there. So you can see, without any more talking about, you can see how it used this wick right there, overshoots it by a little bit. That's normal. Remember, the wicks are allowed to do the damage. So we want to see something accumulate in this area here with a secondary or third reason to be long. And then let's drop down to a lower time frame charts. You just know that this wick right here and this blue shaded dotted line here, which I'll go back to just taking these off, you'll see that that is the Tuesday daily premium wick. Now when I say premium, this is going to be a cause for confusion, because you heard me talk about this is a discount array. If I ever talk about a candlestick and I say it's a premium wick is going to be the wick on the high end of the candle. A discount wick would be a wick on the low of the candle. Okay, so when price is up here, this premium array is a discount relative to where market price is. So it's down there. So just think of it as a premium wick inversion. So it's treating it as a method of going down to go up. That's all it is. Okay. All right. So because we have this levels annotated, and we have Wednesday's daily high annotated here as well, we're going to drop down into the next chart. All right, so this is a 15-minute time frame. So right away you can see the Tuesday daily premium wick consequent encouragement level. So no, it's a mouthful. You can see it trading down into that. And what else is in close proximity to that level at the time that price trades down to it? What do you see? You see that gap right here? So we can look at it like this. I'm already losing my voice. Okay, so you have a gap here, and you have Tuesday's daily premium with consequent encouragement there. And it happens after we get a low form. Notice that? So right away, this is the level I was pointing to on, actually no, it's not true. In Twitter, I was looking at these relative equal highs here, and I noticed on the 1 minute chart. And if you go back and look at Twitter, you'll see that I had noted this before the CPI number was released at 8:30 yesterday on Thursday. I took everybody's attention and said, I like 20,474. It's smooth. It opens at the CPI number, goes right above that, does not take out the high over here. Trades to that, runs the liquidity there, and then drops down, trades into the fair value gap there. Comes back up a little bit, institutional order flow entry drill here, and then dumps down once more, trading into Tuesday's daily premium wick consequent encouragement, which I showed on the daily chart. And then we're at the low, and then it's allowed to do what? Color outside the lines. This is a mohawk. Okay, so inside this mohawk, I'm going long because I'm fulfilling several things here. The market cleared, stops there, dropped, showed a reaction, went to the furthest extreme of that fair value gap right here. This one right here, okay. Trades to the low of it and then goes outside of it a little bit. That's completely normal. It's absolutely normal. And I want to accumulate a long position based on that and anticipate trading up to in the direction of 20,538 on the daily chart. But remember, I don't need that price level. All I need is to trade it to this right here. This dashed line here. And then you have the relative equal highs here. But just above that, how far can it go? Go back to that daily chart and you'll see that that's that level here that I'm annotating. So I want to see this price level traded to. So again, if I think it can trade there, how else can I refine it so that way I have a high probability exit strategy and not demand the 20,538 level, not demand the 20,490 level. So I can choose what? I can choose something very, very small and short term, and it's this high to this high and the high here. So that's why I had my limit order. You'll see it was in the post yesterday and what I'll show here in a moment. So the market then creates all its consolidation, accumulation, and then runs up and bumps the objectives. Did not get to 20,538, and I don't need it to trade here. Okay, so I do believe that the 20,538 is still in play and still a factor for me, but it's not necessary for what I was using yesterday. And then we're moving over to a 1 minute chart. So you can see the levels that this added, which is that fair value gap, and then the initial low, the consolidation, and then drop down at the market opening. Here is the 931 minimum threshold for time. You can't make it earlier than that. So 931, that's your first presented fair value gap. It's small, but it's okay. It's still useful. And the market dives down and trades just below that fair value gap that I showed on the 5 minute chart. So if I scrub over here and show you in the 1 minute time frame where these two blue lines are annotated, it doesn't look like there's a fair value gap at all. So that's why you have to cycle through your time frames down, and you'll be able to refine any inefficiencies, but there's no refinement necessary in here because it's a lot of back and forth delivery, see? So it's all back and forth between this candle, between this price range and this price range defined by those blue lines. It was anchored on the 5-minute chart, and in 1-minute chart, it doesn't look all that inefficient, does it? Now going over here to the time that the market delivered the CPI number, drops down, creates a short-term low. Notice it's gravitating towards that fair value gap, dropping down into there and then consolidating, and then once more diving down here. And what time of day is that? 9:50. If we look at how price reacts there and trades up, we have an inversion fair value gap in here between this candle's low and this candle's high. You can see it trades up, comes back down in, and then accumulates, trades into a propulsion block, which is this down closed candle. The order block's here, propulsion block's here. Look at month 4's content on the 2016 mentorship playlist, and you'll know what a propulsion block is. And it rallies and creates a fair value gap here. Consequent encouragements trade there, rallies up, trades to the low of that shaded pink area, which is that what? Remember that daily chart? I showed you that big range in pink. This is the low of that range. So it's drawing back up into that higher time frame array. It's going to treat it as what? A premium array. They create relative highs, relative equal highs. They bump it, trade it back down into what? First presented fair value gap. All of this consolidation, I'm avoiding all that. And then in here, I told my private mentorship students, I said, note the low of the imbalance, the SIBI on the daily chart, and then note the 538 level. And I'm going to be waiting for a displacement inside that shaded area in the direction of 20,538. There's that displacement right here. And then here, I'm accumulating long position, and I'm going to be targeting that 482.75 level. Put a limit order just around that area and try to gravitate towards that with price. I don't need it to trade to the 20,490, and I don't need it to trade to 20,538. And because I shared my target yesterday, I told everybody on Twitter the chances of it going to 20,538 now is unlikely in the morning, so don't look for that target to be met. It wasn't met yesterday. So the target, I'm sorry, not the target, the high of yesterday came in at 20,503. And then meandering around the rest of the day. And then now today, this is yesterday's first presented fair value gap. And you can see the reaction off of it here. It's probably random. So notice the high here and here. That's where buy side, minor buy side, running from here to here. So finally, we're going to go down into the 15-second chart. And you can see, remember there was a 1-minute inversion fair value gap on this decline here. But I'm drawing your attention to, after trading down into the 5-minute fair value gap, taking the sell side here, and that Tuesday's premium consequent encouragement wick, which is not appearing on here, I apologize, but just go back at the previous video portions and you'll see it. We're doing your chart, which is really what you're supposed to be doing, because if you do that, you'll have a better view. So right in here, you'll see that we have relative equal highs. So we already know what they've engineered there. Then we have the low of that daily SIBI, and then we have the 482.75 level, which is my draw. That was from my trade. That was my turn miss. So I want to aim for that price. And in here, if we add the executions, I'm just going to hover over top the arrows because it'll tell you the price. Because when I put the annotations like this, it just gets in the way and it makes it hard for me to point to certain things. So I just want to let you see it for a second. There they are. But I'm going to take them off and just hover over top of the arrows because it's going to accomplish the same thing, okay? So right here in this drop on a 15-second time frame, you can see, look right here on that blue line. I'm hitting the low of that fair value gap on the 5-minute chart. You see it? That's the price right there. Right there. I'm hammering it there, going long. And then this buy side imbalance, sell side inefficiency. As it's dropping down, I already know what I'm looking for. We have a breaker. A low, high, lower low. That's your breaker right here. That's why it digs down below half of that fair value gap there, because the breaker's candlestick is a little bit, let me make it wider so you can see it. This range here, watch what happens when I highlight that and carry it there, because this is your breaker. Upper half, it's respecting it. Does it go down to consequent encroachment? No. So it's okay for it to trade down in the upper half of this. That's reasonable. You want to see it stay away from the lower half. And at the same time it's doing that, the buying and selling pressure that I like to tell you is going on, it stops it in consequent encroachment here. The bodies never come down and lay over top it or go below it. The wicks are allowed to do the damage because you have to look at why the wicks are being permitted to do the damage. It's digging into some other liquidity, or it's digging into another close proximity array like this breaker here. So you can see my entry there inside of the breaker in its upper half, and then it rallies, and then I'm adding inside of this gap here, and then I'm looking for a partial here, and then it's trading down into the first presented fair value gap there. And there's 5 sold here, and then I closed the trade out manually because my wife required my attention and I couldn't manage the trade the rest of the time. I was being distracted with her. Later on in the day, here's that first presented fair value gap again and again. In here we have the displacement. All right, so in here I'm using the inefficiency here, and then the inversion fair value gap here. So I'm accumulating all of these positions in here because I know that it's not coming back down to the low. It's not doing that. So all of this is this and this. I'm trading all the trades in there, knowing that I have already seen the accumulation required before getting up into that shaded pink area, which is that daily civvy. So accumulating it in here, waiting for a nice rally higher. Once it breaks this high here, it should be no problem for it to trade to my objectives. Above the high, it drops down. It sucks people into thinking it's going to go short. They ride one more time higher, buy side, dropping deep into this inefficiency and order block. And then rallies again. Accumulates around that quadrant in the civvy on the daily chart, and then trades to my objective right there, 20,488, which is less than what? The 20,490 level, but greater than the 20,482 3/4 level that I posted also in Top Steps live stream. So then the market rallies up a little bit further, fails at 509, doesn't go to the 538 level, and falls out of bed precipitously and smashes everybody that wants to go long and goes into a messy consolidation. I want to talk a little bit briefly before we have the CPI number, or PPI number, I apologize. If you ever see a market that has big news impact drivers like the PPI, CPI number like we have here on Thursday, yesterday, and Friday today, you don't want to be trading the last hour on that, okay? And you also don't want to see it happen when you do this. When you have the market trade above a high and fail and create a low and a lower low, come back into the range, then consolidate going into the last hour of the day. When you have that, you've already done two things. Number one, you've created the high and the low of the day, and you've marked the last portion of the PM session's range. So it's not going to make a lower low than this, and it's not going to make a higher high than this. It's going to consolidate back and forth. And you're going to waste your time sitting there looking at live streamers hoping that it's going to do something when it's not going to do anything at all, because it's being strangled. It's being held in place. It's in a holding pattern because it's going to build overnight sentiment. Overnight sentiment is here. Here's 7 o'clock. That's when the market's allowed to trade. See that? That's exactly what I told you to look at. Start following it at 650. 650 is there. The market creates displacement, running what? The buy side. Then it consolidates all the way through until 10 minutes after 11. And then we have what? After taking liquidity here, then it dumps. And now we're ranging ahead of the PPI number, which is where we're at now. So I'm going to use this yeah, we'll just stay with the 1 minute chart. I don't need to do anything else. It's pounding me. We have one minute left, and then the PPI will be in here tearing people's faces off. So you want to look at 15-minute time frame to get a lay of the land. Meaning, where are the liquidity points? Stops. Where is it smooth? Where is it jagged? Where has it been made jagged? Sticking to the long-term bias. Yeah, I'm not ruling out the likelihood of it wanting to go higher, but it might want to smash down lower again, like yesterday before the CPI number came out. It went down to go up, but if we didn't have PPI this morning, this would have kept on going and would have went to 538 and higher yesterday. And we'd probably be opening up above 600s today. But because we have the PPI number here in 10 seconds, don't trade this, folks, because it's going to hurt you if you try. So already, do you want to trade that? Try to put a demo trade on right now. You can't. Trading view always locks up. Which is funny. It's interesting, isn't it? So they left smooth lows here. Notice that. They went down into yesterday's first presented fair value gap, but they left that really too smooth. Whenever I'm looking at a PD array, or if I'm looking at a reason to get into a trade, I'm looking at not just one thing. I'm not looking at just one specific PD array, not one fair value gap. I'm not looking at one order block. I'm looking at three. I'm looking at three things. Three things have to agree. And I'm not even referring to time and price either. I'm talking about three things technically that's inside a idea behind me taking an entry. If it's just me simply seeing an order block or a fair value gap and I want to be long, and buying a down closed candle by in of itself is not an order block, just as much as you might want to refer to an area where it consolidates and then rallies up. There are things that have to be linked in close proximity to that very PD array. So if I'm trading a fair value gap, it's going to be inside of a larger order block, which is after taking a pool of liquidity. And if I'm bullish, it should be below a previous low. So now I'm absorbing, like smart money, that sell side liquidity. So I'm accumulating the sell stops for the express purposes of using it as a mechanism to be net long. So I'm looking for three things to agree. If you look at the points of entries, go through your charts and study, you'll see that it's not just that fair value gap I'm entering on. It's not just that order block. It's not just that breaker that I'm using. There's two other things there at minimum. So your entry mechanism has to have, if it's going to be high probability, it needs, number one, have the signatures that the market is in fact not being intervened. There's precision, there's elements that it's booking price with the bodies inside of the PD arrays. The wicks can color outside the lines. That's always a given. But are the bodies still supporting the narrative that the price should be going higher or lower? But then you're also looking for two other contributing factors to why that price entry should be even considered at all. A fair value gap inside of a bullish breaker after it's taken a smaller short-term swing low out. What's below the swing low? Sell side. You're inside of a bullish breaker, and you're inside of a fair value gap. So you have three things there that makes that an enormous probability for price not to go lower, but in fact to go higher. So there's a lot of blending of things that has to happen. That's why it's important. You have to start with just one PD array. Just start with one of them. And then when you go through your annotations and your back test, you want to be able to see, excuse me, you want to be able to see if there's a confluence or an agreement with other PD arrays that would be similar in the idea that would send price higher or lower in that general area in proximity. So notice that we opened, traded down into yesterday's first presented fair value gap. After trading in yesterday's first presented fair value gap, leaving the relative equal lows here, it rallies up to the low of that daily SIBI. Notice it hit that there. And then look at the reaction. Why would price want to go from here and go higher without taking out the sell side first? Even if it wants to go higher, why would it want to do that? I would not use, like, for instance, like consequent encouragement here. Like if this would have traded down below and came up and created this scenario, I would be trying to go long inside consequent encouragement here, but it has not done that. It's left the sell side. So it's more likely that the market will want to come down here and disturb all this. This is unfinished business here. This is on a high impact news driver, no less. It drops down and stops in yesterday's perfectly to the low of yesterday's first presented fair value gap. What's the price of the low on that fair value gap yesterday? It's 20,364.75. What's the low of this candle? You're looking up here. $365 even. So it's one tick away from the low. Now in this price run here, if we take that from here, you can hear my puppy snoring. Scalp. So we're going to look at this price range in here. And no, we're not going to do that. All right. And then what we'll do is we'll look at it on a 15-second chart. All right. So now watch. On a 15-second chart, it trades up into the low of the daily SIBI and then creates one more high into it, and then it gives up the ghost and trades down. This high is met by a higher high there. The low in between in here is your breaker. This candlestick trades up into it. This candlestick trades up into it. So this breaker is being capitalized. You can short, anticipate what? The sell side annotated. The market breaks down. In every single instance that it creates an up close candle, you want to measure this. Watch. This is your breaker. Right here. So let's annotate that first. Volume imbalance. It redelivers to that and to the breaker low. It's the low candle, down close candle, prior to the run up that takes out the high. That's your breaker. It is not this. It's this. So the market trades up to it, deliveries perfect, breaks lower, and then if you're right, if you anticipate the market doing what? Going lower to sell side, which is below that low here, and that's your yesterday's first presented fair value gap. And relative equal lows that it formed this morning. All this in here. That's what this drop in here was. Watch how you can track institutional order flow. You do not need level 2 data. Okay? You don't need any of that DOM stuff. You don't need volume profile. You don't need VWAP. You don't need any of that stuff. Every up close candle is a delimiter for where price should not go above. So here's an up close candle. The market leaves it and goes below this candlestick's opening price, which is the change in the state of delivery. That means that the market can trade inside of this range, full range. So it looks like this. Actually, I'll get to that candle in a second. There. So inside that area there, you're going to see the order block doing its job. The algorithm's referring back to this candlestick's opening price. So it can trade inside that range like it does here, but it does not take out its high. The market goes up into it. The bodies are respecting the body of that candlestick. Look at the green candle's body here to that candle of that one. Goes up, but then stops. And then we see the same thing happening here. I apologize. You're going to hear that. The guys running the mowers in the back. I'm in my living room, so my wife isn't with me right now. She's out and about. So same thing here. The market trades down below. So it validates what? That's the change in the state of delivery, the opening price, and the candle opens here and then quickly leaves it. So order flow is bearish. All the green candles or up closed candles are doing what? They're limiting the delivery on price to the upside, keeping everything focused on sell side delivery. Sell side delivery continues until sell side liquidity is engaged, which is that low down here, which it trades down to here, which I was telling you up here when it was doing it. Go back and watch the live stream, you'll see that's the case, and it's the truth. And then the market does what? It starts to displace, stays heavy, and then the same thing, we see up close candle, so we can still track order flow. No depth of market. We're not looking at order ladders. I'm not looking at market map. What's it called? Book map. We don't need any of that stuff. None of that stuff is required. Everything in the open, high, low, and close, and time. So here's that candlestick here. Watch. Here's your order block. The candle can do what? Can trade inside the range. Does it leave the upper portion open? Yes. And it rolls out. This candlestick does the same thing here. This change in the state of delivery, that opening price, that's your trigger, same method. Get that off. Every price run, when you're looking at price rallying higher or lower, this is what you're supposed to be doing. You're just going to reverse it when it's going higher. Every down close candle should be performing like this. We have a change in state of delivery here. The candle opens up on this one here, trades up a little bit, but stays what? Inside the range of this candlestick. And it does what? It stays in the lower half. It does not trade or traverse to the other half or up part of it. Stops dead in its tracks, breaks lower. Same thing here. I'm not going to keep painting them out. This is a small one. And then finally, it just does the same thing. Delivers down to the sell side I annotated. Okay, so what am I saying here? High frequency trading algorithms are entering on this low. They're trading above the high here. Then when it breaks down, they're trading short here, trading short in here, they're trading short right on that candle's opening. And when it starts to do this, they cannot enter anymore. Why? Because you're leaving the premium aspect of that range that they're firing on. That's half of the move between this low and that high, which is the reason why when I'm pyramiding, I'm only pyramiding when I'm short in the upper half. And once it starts to displace like this, it's breaching the lower half. So half of that range from where you're targeting and where you're seeing the beginning or inception of the move, you have to define premium to discount.